Welcome back to Real Estate 101. Today we're going to continue our discussion on financial planning and discuss some investment strategies for the year 2014. And I'm pleased to be joined once again by Jeff Gregory of Desjardins Financial. Jeff, welcome back to the show.
Thanks for having me again, Joe.
All right, Jeff, so before we begin discussing some investment strategies for the coming year, let's recap 2013. What can you tell our viewers about some investments in the year 2013?
2013's actually been a great year. Hopefully you've been in the markets. Canada had some very decent returns in the equity style of markets. The US has had a fantastic year. The Dow Jones is hitting records again. So that whole 2008 collapse, in the US it's now past that in a lot of the markets. There's still some growth opportunity. There's still a lot of money to be made, especially in the US more than anything. I think one of the suggestions out there is you need to have more US. It seems that a lot of Canadians are a little slow getting in this, and unfortunately the fear has to kind of come out in an effort to make some good money and get those retirement plans and tax-free savings accounts up to a good amount. So Canada's been good, the US has been fantastic. There are other parts in the world that are doing pretty good. Hopefully you haven't been sitting on the sidelines too long, because you've missed out on a good opportunity, but you probably missed out on the fifth inning. There's still the 6th, 7th, 8th, and 9th inning to go. And if you haven't gotten off the sidelines, it's probably a good time to call me and we can fix that pretty fast.
All right, Jeff, so based on this year's track record of investments, what would you say was a good, safe investment?
A good, safe investment may have been a good Canadian dividend style fund. Banks, a lot of the banks and a lot of the the TDs, the Royals, the BCEs have been increasing their dividends. Which usually just means a dividend is profit. So it's the distribution of the profit from a company to the shareholders. So if you've been a shareholder holding some of the stock, maybe a mutual fund in that way and getting that exposure, you're going to get a piece of the pie. So rather than always paying those fees, and the one thing I like holding, bank investments one way or another, mutual funds and so forth that have good dividends, because what it ends up doing is paying back. If I got to pay those fees at the bank all the time, I'd like a little bit of that money coming back. So dividends have been good, safe ones, good balanced funds. Just nothing that's been government bonding right now.
All right, and so what about capital markets? How did they do this year?
Did very well. You look at the Toronto Stock Exchange, and it's grown quite a bit. The Dow Jones, it's hit over 16,000 as of just now, so they took a break. They called it Thanksgiving, which is funny. But it's been running very well. We're now at the point when they're starting to be worried. Maybe it's gotten too hot. Well, all it did was just get back to kind of where it was before the 2008 Lehman Brothers and the whole global recession collapse that we had. So we've broken the records, but all we've done is gotten back. We haven't grown. When you look at a lot of other world markets and so forth, China and India have been a little bit slower, but they still have 7% growth. I don't know about you, but 7% growth is still not too bad, but it's been beaten up really bad. So there's an opportunity there somewhere in the near future that they're going to realize, well, at 7% growth, that's still better than Canada at like 2, and the US at 2. They are expanding. They're just, some of the numbers make sense, some don't. Gold apparently might have some opportunity. We'll wait and see on that, and the fears of oil. Too much inventory, not enough usage. So it's really interesting what 2014 is going to bring. I think it's a good time to be a smart investor, not a crazy aggressive investor. There's a lot of smart money on the tables. A lot of corporations are not just U.S. They're not Canadian anymore. It's global. Everything is global. So when you're looking at Europe and you're looking at, there's different parts of Europe, Southern Europe, Northern Europe. When you're looking at Brazil and they're getting ready for their World Cup and the Olympics, and it's a really good, interesting time. Even African nations have been expanding their markets and becoming globalized players. They're trying to become westernized. And when you get that, you get this whole spending spree. And it is a very, very unique opportunity right now.
All right, so let's talk a little bit about 2014. Do you have any investments in mind that you think would be good, safe investments for any viewers of our show?
Yep, I think anything that pays an income. So anything that has a dividend associated with it, I think are going to be safe. Careful what kind of dividend it is, but anything that does pay that is going to be a-okay. I think anything that is more got a consumer style product associated with it, we're getting back into buyers. We're not just raising debt up to the yin yang like we used to. I think if you take a look at anything U.S., the underexposure to American markets right now on the average Canadian is alarming. And I think it has a lot to do with not reviewing portfolios enough. Not enough people take a look at what they have, either their group RSP plan or their pension plan or what they have at the bank or stuff like that. They're not getting prudent advice. You need the advice. It's your money. Make sure that you're taking it very seriously. So the US, too many people are still sitting in GICs and government bonds. And that is horrible right now. Government bonds are down like 2-3% this year. It's a government bond. Why? Because they expect interest rates to go up. Get out of these things. And if you've been holding it too long, a lot of good, just safe, core American funds have done like 25%. You're getting -2. That's where the money is.
All right, so what about the U.S. market? Do you think they're poised in 2014 for more growth?
Oh, certainly. I think they are very poised for more growth. You got some elections coming up sometime soon, so that gets a little bit of the excitement going. I think the political influence is starting to not have as much effect. When you saw the government shut down, about 2 some odd years ago, that would have dropped the market very heavy. It didn't affect it at all. So that means a lot of the tactics by the U.S. and Washington don't seem to be working so well. When you look at corporations, because that's really where the money is. Corporations aren't based in the U.S. anymore. Walmart is such a globalized player that you don't have to worry about, is the U.S. market down or is the Chinese market down, because it just worries about is the global down. And when you look at things, and these are going to be some terminologies, but you look at their price-earnings ratios. And at the peak, price-earning ratio is basically how much you're willing to pay for the stock versus what your stock is worth. An average, 18, 19, 20 multiples have been somewhat average during growth. A lot of them sitting around 14 right now. So they're still cheap with big returns that have come back. We're hitting market highs. The U.S. Corporations got really smart and they trimmed down. The way I try to describe it to a lot of my clients and people who listen to me is the U.S. had an angina attack corporately. So they realized they needed a diet. They had to eat better. They had to be a little smarter. They had to be a little more conscious. They got a spook put into them. They're sitting on a lot of cash. And if the government, U.S. government, releases some of the rules and lets them repatriate that money back in, then watch what will happen. Your mergers and acquisitions, you're going to see big growth. So there's a lot of opportunity that if the government can encourage that money coming back from a globalization back in the U.S. into the headquarters and that, it's a really, really unique, interesting opportunity.
All right, Jeff, so what about interest rates? What do you see for 2014?
My foreshadowing into 2014 has more probably, it's going to go up. It has to. We can't be this low this long without some form of bad medicine coming along the lines. We've been thawing, from a frozen economy, but it is going to have to go up. Maybe a 1/4 point, maybe a 1/2 point, but it won't be drastic. We're not running that well as an economy, so they're not going to.
It can't be drastic.
It won't be too drastic. But there are some parts that have already factored in the interest rate increase, and it hasn't been there. Mortgage rates. Mortgage rates have gone up almost 1 full percentage point in the last 6 months, but there's no interest rate increase. So that's usually signs. When you see mortgage rates going up without interest rates, those are signs that it's coming.
They're expecting.
Yeah. Bonds have actually massively underperformed. They've been a fantastic investment for 3-4 years, but they're underperforming the last year with the expectation that interest rates are going to go up. Nobody wants to hold a 4% bond for 5 years knowing that interest rates will get higher and they're stuck on a lower performing. So if you're in bonds, GICs, right now, don't lock into long-term GICs. GICs are still good investments. They make sense, but a lot of times they're used improperly. So there is opportunity in there within the GIC arena, and as being a broker of GICs, you'd be surprised how many people want the business, how many people don't. It's going to go up. Clean your debts, get your house in order, and then get ready to make some money and invest it.
All right, so for 2014, let's talk a little bit about oil. What do you forecast in the oil markets?
It's funny because it's almost like a 50-50 split. Some are saying up, some are saying down. I would see it probably a little more down, if not flat. There's more inventory going on, but not much usage. But when you have things like the argument of pipelines, depends maybe how cold the winter is. I think it's going to be factors that affect oil usage more than things like controls and stuff like that. So a harsh winter and oil's going to go up.
Yeah.
You know, if we have some battles within the Middle East, oil's going to go up. It's going to be those factors that are going to cause a lot of the price fluctuation. It's not a lot of intrinsic, just basic price situation. So oil could be somewhat hit and miss. I would probably aim a little more to miss than I would aim at hit. Although the price at the pump will still be ridiculous.
All right, Jeff, so any last tips for viewers of our show that are looking for some investment planning for 2014?
Certainly. January, February is typically RSP season. The sooner that you can get that started, the better. Review this portfolio. Sit down and get some proper advice with somebody with some credentials at the end of their name, the CFP and so forth. Somebody who knows what's going on and you feel more confident, has insight into what's going on and expectation of what growth will be. Don't just do to do. Right? Don't pick your own investment. If you are crafty enough and smart enough to be able to manage your own investments, fantastic. If you're not, you don't have the time, then individuals like myself are great resources, and use and abuse it. This is a time to be a little more greedy than what we've been into. Take advantage of it.
All right, Jeff, great stuff. Thanks for coming on today's show, and I'm looking forward to seeing you next month just before Christmas.
Excellent, looking forward to it.
So there you have it. If you're thinking about investing in 2014, get in contact with Jeff Gregory at Desjardins Financial. I'm your host, Joe Terceira. Thanks for watching, and we'll see you next time.